Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Hey Ben, welcome to the podcast.
Thank you very much, Owen. Thank you for having me here.
Yeah, it's going to be good, mate. You've done one live show with Chris and I. It was on YouTube. It was a super popular live show we did a while back. So this is the first time that, correct me if I'm wrong, it's the first time that you and I have done one. It's just the two of us, right?
That's right. Right.
But I've known you for a long time because you've helped me out and my partner, Sarah. You've helped us both out with our financing needs. And I've known you through Chris for ages. So this is going to be a really good chat, and the people will get a glimpse into who you are, but also this idea of kind of using your property and the financing process in new and interesting ways. And this might particularly be the case for business owners that listen to this. I think they'll find this really, really interesting because we talk a lot about that, the idea of using property as security or property for financing purposes for a business, as well as investing and all those other things that we talk about. But for people that haven't worked with you or the Flint team, can you tell us a little bit about yourself? Like, I'm keen to understand why you decided to move into mortgage broking.
Yeah, absolutely. So I'm currently the head of ICE at Flint, but I actually started my career in the financial planning and accounting world as a paraplanner and accountant initially. And it was actually at the first financial planning practice that I worked at straight out of uni that I met Chris. That was in 2010. So it was about 4 years working in the capacity as a PAYG employee that I pretty much said I'd like to have a go at working for myself. And I was pretty much in for a rude shock.
yeah, as we all are.
Yeah, but ran a paraplanning business. At one point in time at our peak, we were probably writing up to close to 1,000 statements of advisors for financial planners in a year. We had a team of about 15.
Wow.
And that was about 4 years into that journey. And I kind of thought, I kind of had a realization that this is probably the peak of where I'm going to go. And I think it was a bit of a sad realization, but also a kind of epiphany that, I think that I would probably be better as a number 2 or number 3 rather than a number 1 and driving the business. I think I was quite brutal and honest with myself and realized where my weaknesses and strengths lied. And I actually had that conversation with Chris. And, right after, Chris pretty much said, come on board. It was a brand new industry, but there was a lot of carryover from the financial planning world to the mortgage broking world. And in fact, I think in mortgage broking, there are elements of accounting, the elements of financial planning, and there's also the credit piece. So I actually found it very fascinating and dove straight into it, really enjoyed it. And, as they say, the rest is history.
I'm fascinated by this, Ben. So for folks that don't know, paraplanning's like where the actual work is done. When you go see a financial planner, there's a paraplanner that sits behind them that does all the crunching of the data, the creating the advice strategy, and then the advisor oversees that. But for you to be doing, and your team to be doing 1,000 a year, that's big. Like that's impressive for people that don't have context. That's really impressive. But I'm really interested to know, what did you think it was in your skill set that made you have this realization that I'm probably better as number 2 or 3 in this rather than the one leading it, so to speak? Like, what was it that made you think that?
Yeah, sure. So I think, and there was certainly an aspect of having to go out and get business and drive sales and build relationships as part of running the business, that I think most business owners would have to go through. But I guess I just realized that it wasn't one of my core strengths. It was something that I had to learn how to do as part of
Yep.
running the business, but it wasn't something that came naturally to me. You know,
Hmm.
uh, I think as part of that process of being honest and kind of analyzing where I sit, what I want to do with my career, where I want to be, I kind of realized that, I probably lacked that. I still wanted to grow. And don't get me wrong, even when I say that I think that was one of my weaknesses, that um, didn't mean that I just wanted to give up on growing that side of things. But,
Hmm.
I knew that I wasn't as charismatic as, a personality like Chris, for example,
Yep.
but, my strengths lied in, I guess, the operational side of things.
Yeah.
I've got a lot of attention to detail. I love the number crunching. I
Hmm.
love working through policy and coming up with innovative solutions. I love diving
Yeah.
into financials. So I think we were a really good partnership with each other initially. And yeah,
Yeah,
um,
man. Yeah. Yeah. It's actually been really interesting talking to you over the years and just working with you and just hearing like I see that. Like I didn't know that backstory that you had. But like I kind of like picked up on things like that, like the more subtler things about how you go about things. One of the obviously people that listen to the show regularly know that you are and the team at Flint were like formerly Blask and voted like the number one brokers in the country, basically. Um, and that doesn't just happen. So I'm curious, like if we look at what you do day to day as head of advice at Flint, we see and hear Chris on the podcast or Christian over on LinkedIn or whatever. But your role specifically, what is it that you actually do?
yeah, sure. So I guess I manage, I guess, the fulfillment engine
Mm,
of Flint. So I guess what we've endeavored to do is we've kind of tried to split the broking process into the sales and relationship building side of broking, and that's really Chris and Christian's area that they manage. And then I work with strategists, credit analysts, and the loan processors to pretty much get loans approved. The strategists are essentially, if you think about it, non hunting or non sales oriented brokers.
yeah.
We focus more on the number crunching, the policy navigation that inevitably comes with applying for a loan. With looking to find innovative ways to maximize borrowing capacity, and all those sorts of things. So my role as head of advice, I guess, is to challenge that, and to think of, particularly with the more complex, and typically I think a lot of self-employed clients, they probably fall into that realm, especially there's multiple entity type structures, and this is where the accounting knowledge or the accounting background also comes in handy. But workshopping with the team to find solutions, to
Mm.
optimize lending structures, so that they are working with accountants and financial planners as well to, help clients achieve the best lending kind of structures and facilities to help them achieve their goals.
And this is why I wanted to talk to you specifically, is because I've been in this boat, right? As a homeowner, as a business owner, with financials sometimes all over the place. And then like one year it's really bad, one year it's really good. And then a typical bank, they see you coming, they're like, oh, quick, shut the doors. Don't let that person in, right? Um, and for many of Australians, whether you're a sole trader, you got a small company or a medium-sized company, it is not as simple as you go onto the online calculator, click apply. Like it is not in any way like that. And so many of our listeners will fall into that. Anytime something is like slightly out of the ordinary, the banks, it just gets complicated. The banks just make it a fuss. They say no, they knock you back for this, and it's just a pain in the backside. So that's why I obviously work with you guys on everything that I do now. But let's just think about property as kind of like something that exists in order to help you do other things. And one of the things that it helps you do, and we've talked a lot about this, Chris and I talked about this a few months ago on an episode, is the idea of like using equity in a property to do something else. So let's just start off with that. How do you see a lot of Aussies using the equity that they've built up in their property, whatever the property may be, to do something with? Like, let's just start at the top, the simple one.
Yeah, absolutely. So, property being one of the biggest asset classes in Australia, I think there's lots of pros with regards to investing in property. It's also a lifestyle asset. It's where, you raise your families, where you live, et cetera, et cetera. But I think one of the biggest downsides towards property is that it's illiquid. So, even if, your property is growing for you and building your wealth, you might not necessarily be able to tap into it. And I think that's where the equity piece of releasing equity can be very helpful. And you can release equity or growth in your property to help with your deposit for another property purchase. You could use that equity to diversify and invest in the shares, for example. And you could use that to facilitate, some minor renovations on your property itself. And sometimes it can even act just as a cash buffer or insurance policy, because you could release equity. And I think the best thing about releasing equity is you could also utilize the offset facilities that come with most loans these days. And you could put it in the offset facility, and that means that if you're not using those funds, you don't incur any interest on them. So it's really just a cash buffer.
I was chatting to Chris about this the other day, actually. A lot of people in our community, when they're like pregnant or when they're planning to have a family, what they do is they refinance, not for any purpose other than just releasing their equity to put in their offset account. Because if they're going to go down to one income, then all of a sudden they've got this big buffer of an emergency fund, what we would call an emergency fund, Ben, and they just kind of like leave it there. Because like you said, it offsets any interest, but it's available to them if they need it for whatever reason. I don't know if you see that often, but I definitely see it a lot.
Yeah, absolutely. And I think particularly for, self-employed, or business owners, I think there's an element of safety there, because there's already so much variability with, the business and with, profit levels. Like just having an additional 50 grand, 100 grand, whatever it may be, sitting there, I guess it allows you to be a bit more bullish with your business, because you've got that kind of safety net. And ideally, you don't want to touch that. It's meant to be there, and it's meant to, offset that interest. But just in case, and there's so many things that we can't account for, it's there.
Yeah. So the big reason that the big topic I wanted to talk to you about is when people use this equity, or they use property generally. It doesn't have to be necessarily the equity component, but just generally how business owners can leverage their property assets. And over on our Australian business podcast, Ben, so we're recording this for both shows, the property podcast and the business podcast. We have about 10 or 11,000, we estimate, business owners, whether they're micro business owners or big business owners, or people that maybe even intend to start a business soon. Now, one of the things that you and I have been through recently is this idea of using a property for business purposes. So using it as security for a business loan, or for a loan that then is like in an individual's name that's then given to the company, and all these different types of things. Can you just talk to us about this approach? Like, how does that generally work? What are the ins and outs?
Yeah, absolutely. So, your standard residential loan, you can borrow up to an 80% loan to value ratio, or LVR, without any mortgage insurance being levied by the banks. Now, and that's typically the point where most banks are happy for an individual to release equity up to. Now, if you're self-employed and you're looking for some additional funding to help grow the business, then there is the possibility of taking out a secured business loan, secured against the property, using that remaining 20% equity in the property. And that is probably going to be the lowest cost of funding that a business is going to be able to acquire, because it is secured against the property. That might allow for more flexibility for a lot of business owners to kind of fast track their trajectory and business growth, right? Well, of course, there are going to be risks associated with that. I think anytime you're using debt, there is going to be risk, but it is a tool to help you leverage and fast track, I guess, business growth.
Yeah, of course we should all obviously outline like the risks of that, but it's also, there's also a lot of positives to using debt over, say, other sources of funding. So that's actually the next question that I had in mind, Ben, is you as, an accounting background and your own business, being a business partner in Flint, like all of these things, like you wear not just the property hat, the financial planning in your background as well. You get all the hats, what they come with. Can you talk to us through some of the advantages of using this type of structure versus the alternatives, which might be like, say, I don't know, like equity or even just self-funding?
Yeah, absolutely. I mean, I think if you think about the business cycle, the point at which most business owners are looking to get some additional funding is probably a period of big growth. And I guess, if you think about it, that's the time where, business owners have put in all the work. They've probably gone through a bit of financial pain with having to invest in the company. And that could be, investing through own funds, through maybe even help from family or friends. And then they get to this point where they need some, substantial funding potentially to take it to the next level. And, I guess the two probably common sources of getting that funding could be that you get investors involved, or, you could look to get funding from a bank in the form of a loan, a business loan, et cetera, et cetera. If you think about those two main sources of funds, if you have to get investors on board, you're actually giving away a large piece of the company, which means that you're sharing in your share of the upside, especially because the business will typically be going through a growth phase, is going to be less. Whereas, if you're taking out a business loan against your property, yes, obviously you're taking on all the risk yourself, but it also means that you get to enjoy all the upside.
Yeah. And that's the thing, is like a lot of, like you said, I think that's really the life cycle piece that you said there is really important. Like typically when you go to get a loan, as opposed to that initial self-funding, your business is already on its way and you've kind of quote unquote crossed the chasm, as in you've kind of got your systems in place. The idea is no longer just an idea, it's an actual business, because otherwise no one's going to give you any money for it, or you're probably not going to reinvest in it or whatever. And so at that point, at that critical moment, you have a choice of, do I sell shares and give up percentage ownership in this business and get that money in? Then the new shareholders benefit from all the upside, but haven't had to put in the last X number of years or whatever it is. Or do I take more risk, but use a loan where I don't have to give away ownership? And yeah, the downside is the business doesn't work and now I've got a 100% loan or whatever on my property, and then I've got to service that. So there's kind of like that, you can see how that could go wrong, but in terms of the upside, you can also see that there's a meaningful upside. I wanted to come back to something you mentioned before, which is that the idea of growth. You mentioned to me previously when we've spoken about this, that the key thing with the banks is when they do this type of lending, they do want to see that you're growing. Did I understand that correctly?
Yes, absolutely. Absolutely. So, I think it's substantially different if you're looking to get a business loan for cash flow purposes, I guess, which indicates to the bank that you're not in a growth phase. You're kind of we need some help surviving. And I think, when we talk about the risk, I think that's probably, where you want to, make sure that it's going to help facilitate growth. Especially because, business loan, the cost of funding, even though it's secured against your property, you're probably going to be looking at an interest rate of around 7 to 8%. So
Yep.
it is higher than a home loan. But, versus something that's unsecured where it could be in the 9s, 10s, maybe even higher than that, it's still going to be your lowest cost of funding. So I guess if you think about it from that perspective, you want to make sure that it's going to help facilitate growth in the business that is going to outweigh that cost of funding.
Yeah.
And that's how you're going to manage the risk.
Yeah. Yeah. And that's how I think about it, for what it's worth. Like, that's how I think about, because I think it's when you take on a loan or something like this, that's, you're putting yourself on the hook, but also the business is on the hook because it has to deliver. It's kind of like you have to shape up, as in you have to have everything ready to go. And I'm curious about this, is like, when it comes to preparing yourself or your business for something like this, what does a bank like to see? And I guess, what is the process around this? As in, like, obviously the bank wants to see that you're doing a good job and blah, 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 blah. But like, what do they actually want? Like, what information would they want if I'm going to go for one of these loans? What would they actually want from me as the business owner?
Yeah, sure. So similar to your typical loan application process, any self-employed borrower, you're obviously going to have to provide financials, show how the business is done, and that's how the banks are going to calculate your serviceability and what you can service.
Mm-hmm.
But on top of that, when you're going for a business loan, the banks are going to want additional information. So usually there's a period of time, and it's usually 18 months from when the financial year ends, that we can still use those financials. So for example, we've just started the 25 financial year, but most banks would be happy to accept the 23 financial year financials at this point in time. Now, if you're going for a business loan, the banks are going to want to look at more current information. They acknowledge that, the 24 financial year tax returns are not due as yet. For, most business owners, that's only going to be due sort of within that March to May period next year.
Yeah.
But they will want to see, draft financials or management accounts that show how the business is doing.
Yeah.
And then on top of that, they would also like forecasts of, how are you going? Number one, you're going to have to, and I guess not just for the loan application process, but there's probably also worthwhile in figuring out, how am I going to use these funds? How am I going to make sure that I can generate growth in business that substantially outweighs the interest costs that the business is going to incur? And as part of that, the banks will want to have that, I guess, that piece as well, in terms of how you're going to use the funds and how is that going to translate into the financials over the next 12 months.
Yeah. So that's where I imagine a lot of business owners would probably have the help of an accountant to kind of create a business forecast to demonstrate previous financials and how this new money coming in might lead to the uptick and those types of things.
Correct.
Yeah. Okay. So, and then, not that we want to ever go through this, but if basically I'm just going to quickly touch on this, is like, if it goes wrong, obviously, it will fall back on the person who, like, the business collapses for whatever reason, and then it falls back onto the person after the fact. So that's obviously what people would have in the back of their mind, is like, that's kind of the big risk. But what else would you say to people that are considering this in terms of like their own situation? Like, I don't want to. I know you don't either. Like, want to do this episode and talk about these things, and then people come in with these ideas like, "Hey, this is my business," blah 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 blah. Like, we've all heard the stories of people that go and get a loan for their business. The business collapses, and then they're left with more debt. So, like, what else should people be considering in terms of like how this might affect their personal situation, if that makes sense?
Yeah, absolutely. So, and I guess this is where the security piece comes into play. And you've got to be very wary of the fact that you're securing this potentially against your own occupied home, which is the home where your family's living in. And because, you're taking out potentially loans up to 100% LVR, if something does go wrong, your property is going to need to be sold. Because it's a 100% LVR loan, pretty much all the proceeds are going to go to the bank. And if you aren't, and if you weren't able to achieve a sale price that was equivalent to the valuation that the bank used, you might still be out of pocket.
Yeah.
So it's not just the business that's going to be impacted. Your personal lives, the lives of your families, will be impacted if things go wrong. So there's obviously a lot of upside with regards to having access to this source of funding to help you accelerate that business growth. But I think everyone also needs to be wary of the risks that are involved.
Yeah. I wanted to ask you, when it comes to these types of things, I imagine not all banks do this. So I could be wrong about that. Like, I know that like NAB's obviously like the big business bank. We've got like Judo, which has come on the scene in the last, say, 5 years. CBA's flagged that they want to do more business lending. Are there particular banks that people tend to use for this type of stuff?
So most of the major banks do have like a business banking division. But certainly some banks would be easier to deal with, and it would be easier for you to get your loan approved with. And that's where we typically have a preference. NAB's already kind of advertised them, and they love the moniker of being, the banks for small businesses.
Yeah.
We have a preference of working with them. But certainly, we will also consider the options that are offered by the other major banks and even some of the other non-bank lenders, like you just mentioned, Judo. Judo's big in that space. But typically, our preference would always to go with a major first, because they're going to be offering the best rates. They've typically got access to the lowest cost of funding. And then if needed, or if we can't find a solution there, that's when we'll go to, other second tier options.
Okay. So I've just got one final question, which is more so around like if a business owner is listening to this, how they, like what you would say to them. Like if anyone's listening to this, they hear us talk and this is maybe the first time that they thought, oh, this actually makes sense how this might work for me. What advice would you give to them? I've got some of my own, but I'm curious to hear what you would say. Absolutely.
I would say for any business owners or self-employed borrowers, I think there's a big planning piece. If you're looking to buy a property, if you're looking to take out a business loan, I guess it's quite different to a PYG employee where you provide 2 pay slips and the bank goes, you're good to go. There's a big planning piece, and the banks want to see that financials are ready, that you're up to date with your tax lodgements, that everything's been paid on time, etc., etc. And I think also when you work for yourself, I think there's an element of and you'd probably work with this with your accountant as well, of tax planning. And I think there is a little bit of flexibility with regards to, especially when you're coming up to the end of the financial year, should I prepay expenses, so that you can reduce my net profit and pay less tax? Should I, delay an invoice so it gets paid in the new financial year so that there's less revenue and therefore less profit and less tax I need to pay? I think one of the things that you need to be aware of is that oftentimes what is good for tax purposes in terms of minimizing your tax is not great for borrowing purposes, because for borrowing purposes, the banks want to see a stronger net profit, which shows that the business is more robust. So I think balancing that is important. And also, I guess, there is a preparation piece, because if you're preparing to buy a house, I think to be aware of that and plan it with your accountant, plan it with your mortgage broker. That's probably going to result in a better outcome and helping you achieve your goals.
Yeah, you make a good point there, because like if you're like Chris has told us on the podcast plenty of times, is that if you're a self-employed person looking to buy a house, you might need financials, you might need things. It's not as easy as just, like you said, printing off some pay slips and handing them to the bank. And so I think that my advice would be like work with professionals and work early. And that could even be right back to when you started your business. Did you get good tax advice for structuring your business and family trusts and separate company structures? Or for example, a lot of people in our community, Ben, in our business community, are sole traders that don't even know that there may be exemptions to switch from a sole trader structure into a company structure while avoiding all of the tax nasties. Like a lot of them still think you need to sell and then rebuy the assets and incur weird taxes and stuff. But having a good accountant and working with them in advance, and then saying to your mortgage broker as you're doing that, hey, in X, Y, Z months or years, this is the big plan. Let's start thinking about financing. Let's start thinking about how we can make it look good. And you alluded to something there, which is what I know a lot of my tradie mates talk about, which is they're getting a lot of cash jobs. They're not getting as many as they used to, but having putting that through the P&L, yeah, you pay tax on it. But hey, what that does is then that boosts your profits, and then that gives you more borrowing power, and it makes you look more legitimate as a business owner, and then it gives you more flexibility. So yeah, there's pros and cons to that, of course, and we're not advocating for doing cashies and all that sort of stuff. But at the same time, like being realistic, don't go and buy that new Ford Ranger in this financial year if you're going to borrow next year for a business expansion. Like that's just madness. Don't do that. So just having a bit of planning would be really smart there. And mate, this is I know this is a bit of a shorter chat for people that listen to the show, but there's a lot of nuance in this, and there's a lot of situational readiness. That's like, you need to be ready, you need to be in the right situation, in the right time for your business. But if you are those things, this would be a really high value conversation for people. So I'm really happy that you were able to just take some time out of your day and talk me through this, like as someone that talks to you about these things for my situation. I know others will appreciate it too. And of course, folks can get in contact with the Flint team. There's a link in every show notes to do that. So I'll make sure that's highlighted for this episode, Ben. Really appreciate you taking some time to join me.
Awesome. Thanks for having me, Owen. And yeah, chat soon.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.